Now, unless you have been living under a rock, you will know that the Federal Reserve is going to increase the interest rates this year. Over the last few weeks, I've noticed an increase in the number of content assuring people that a rate hike would not negatively impact the market. And based on past performances, we can expect the market to continue going up. While I'm not here to predict how the market will behave in this round of rate hikes, I want to point out the flaws in blindly relying on the past performances to project future returns expectations. In this video, I will show you two reasons as to why the behavior of the S&P market in this round of rate hikes may be different from its behavior in the past, and why you should not blindly rely on past performances to form your future expectations. Without further ado, let's get started. Number 1. Changes in the sectorial proportion of the market. Now, the S&P had been around for over 162 years. And over this duration, you can be damn sure that the index itself had undergone numerous changes in terms of the companies that are included and the sectorial proportion of the index itself. What this means is that the index that we knew of 50 years ago will exhibit a very different behavior as compared to the index that we are all familiar with today. The reason is that the companies that are listed within the index itself from the past and present are different, both in terms of the nature of business as well as the industry that it is in. Just take a look at how much the sectorial proportion had changed from 1969 to 2019. You will realize that in the past, the S&P is heavily focused on industrial, energy and consumer staple sector, whereas the S&P today is more balanced in terms of the sectorial proportion. In fact, over the years, the growth sectors like your tech, financials and real estate had increased substantially in terms of their share in the index itself. And these sectors are more sensitive to interest rates changes, unlike your more defensive sectors that are more dominant in the past. As investors who are investing in the S&P index, you should be aware that the index changes almost every year. You should also be aware what these changes are and how it affects the nature of the index behavior, instead of blindly projecting the past into the future. Moving on to my next point. Number 2. Difference in the market valuation environment. The next reason why the market may not behave the same as it did during the previous rate hike is due to the valuation environment that we are currently in. Unlike the previous rate hikes, you will realize that the valuation of the market that we are in today is significantly way overvalued than the long-term average and the majority of the valuation multiple that we were in during the past rate hikes. And what this means is that statistically, there is a lower probability for the market to perform well following the rate hike as we had done in the past, as the current valuation environment is already very stretched. If indeed the market continues its upwards trajectory, despite higher interest rates and lower business profits over the next 12 to 24 months, you should be very careful as to how you manage your portfolio, as we are probably in the end game when that happens.
That up there, that's the end game. How are you guys planning on beating that?
The solution? Focus on valuation and ignore the rest. So what can you do, or rather what should you do when managing your investments in a rising interest rate environment? Macroeconomics forecasting is often associated with low levels of accuracy simply because the topic itself is too complex. And as an investor, you will be better off focusing on the fundamentals of the businesses that you are investing in and the price that you are paying for, as both of these factors are within your control, unlike the macroeconomic events like rate hikes. Nobody knows how the market will behave a week, a month, a year from now. But what you know today is the price that you're paying for on your investments and whether or not it is over or undervalued. Remember, price is what you pay and value is what you get. Nothing good ever comes from overpaying for something, regardless of how good the company or the investments may be. A good company does not immediately indicate a good investment opportunity. Summary. So there you have it. These are the two reasons why this time the market might behave differently as it had during previous rate hikes. To recap, the first is that over the last 50 years, the S&P Composite had experienced significant changes in the sectorial proportion. As a result, the behavior of the market had changed significantly, as the S&P now is more dominated by growth-oriented companies as opposed to defensive sectors and companies that were more dominant in the past. The second is in terms of valuations. We are currently trading at a multiple that is significantly higher than the long-term average and the multiples during previous rate hikes. As a result, there's a higher probability that the market will undergo a correction instead of marching upwards during the next rate hikes. As investors, we should focus on things that we can control, such as the fundamentals of the businesses that we invest in, and ensure that we do not overpay for any of our investments, instead of trying to focus on macroeconomic events that are way beyond our control. Now that's all I have for this video today. If you found this video useful, do drop me a like and subscribe to this channel to stay updated with the weekly upload. If you do not know how to get started with your investments, or if you do not have the time to manage your own investments, you can consider engaging an independent financial advisor who can help you make sense of the market and shortcut your wealth accumulation process. To find out more information about how you can benefit from my financial and investment planning services, you can check out what I do on my website and reach out to me directly. The link is in the description below. Stay safe and I hope to hear from you soon.